Stop losses do not work. Obviously, I'm joking. They work, but there is a very high probability that you are implementing stop losses in the incorrect way. Do you feel like you're getting faked out on every single move? Do you feel like you're getting stopped out much more often than you should? Are you finding yourself making the right decision originally, getting stopped out, then watching price progress in your favor? If any of these things sounded like something that you're going through, stay tuned, we're gonna walk through all of it in this video here today. Hi, my name is Tori Trades. I've been trading for 11 years now. I am a trendline trader, and I wanna walk you guys through how I use something called a safety line. So before I walk you guys through actual examples on the charts, which we will get into, I wanna see the actual problem. Let's get to the root of the problem here. What is the issue? Most traders don't actually understand risk. Everyone and their mom preaches 1 to 2% for beginners. Cool, got it, amazing, but like, where do we put the stop? Is it random? Is this even a setup I need to take? Is this one that I need to pass up on? So how do we find structure, and how do we incorporate market structure into our stop loss placement or into our risk management? This is what a lot of traders do. One, they'll pick a random ass dollar amount. The market does not care that you want to lose 50 bucks or 500 bucks or 5,000 bucks. Placing your stop at a random number that you feel comfortable with, it's not going to work. So if this is the issue right here, we're gonna make a lot of progress in this video. Now, some other traders will incorporate supply and demand or support and resistance levels for their stop losses, which is totally fine and fair. Maybe they'll utilize like some previous swing lows or swing highs, but if you are trading a trendline strategy and you are implementing a support and resistance style stop loss, they do not complement each other and they will not work together. Now, if you are looking to implement my strategy, we need to use dynamic risk, not just a static support and resistance stop loss. So I'm not saying that stop losses are wrong, and I'm not saying that utilizing support and resistance for your stop losses is wrong either, or some previous swing highs or swing lows, but I'm saying if you are incorporating a trend line strategy similar to mine, you need that dynamic risk, or you're going to find yourself getting stopped out on a regular basis, not being able to stay in for the entire trend or the entire move. So instead of doing that, instead of the swing highs, swing lows, the support and resistance, the key levels, the supply and demand, or the random dollar amount, please don't do that. I want to introduce you guys to something called the safety line. This is how I manage risk dynamically. The safety line is not a static, fixed stop. So the safety line utilizes trend lines, obviously, but it also is dynamic. It utilizes structure and price behavior. So let's say that I get into a position and I'm anticipating that the price is either going to violate or respect one of these trend lines. I need to make sure that I'm allowing myself to stay in this position for the entirety of either the new trend or the current trend. This is either a trend reversal or you're getting in on the trend. Trend is your friend. And this safety line will essentially tell me how long to stay in my position, when to either close when I'm wrong or when to close when I'm in profit, and when to exit, essentially. So how long do I need to stay in this trade? So this is the coolest part about the safety line. It's very dynamic. It truly allows price and market structure to do its thing and to tell me when the trend is either over or when it's been violated. So now, moving stops. This is a little bit more of an advanced tip, and some may be able to utilize it, some may not, but there are some brokerages, some prop firms, some platforms that will allow you to automatically trail your stop so that you don't have to manually move your stop along a trend line every either 5 minutes, 1 hour, 4 hours, depending on your time frame. So some programs or platforms will allow you to do that automatically. I don't use a brokerage that allows me to trail my risk automatically, so I have to do this manually every single either candle or previous swing on the trend line, but I am constantly moving my stop as price progresses. Now, one thing that I won't allow to interfere with moving a stop loss is fear. I'm not going to move my stop loss based on fear. I will just simply move it along the trend line as price is progressing, as it is creating these pullbacks, as it's ebbing and flowing along the trend line. I'll give you just one more breakdown before we actually get into the charts, but if you can think of it like utilizing a trend line strategy, obviously you want to implement the trend itself to tell you where to take your loss or where to close your profits, or how to manage your risk. And the coolest part is this safety line, which I'll get into with you guys in a moment, is that we're simply placing our stops based on the trend lines. So let me walk you guys through what this actually means now. Okay, so I want to give you guys an example that is probably something you have experienced again and again and again and again and again. So I've got my charts marked up already on Bitcoin. I've done my top-down analysis. I've followed my guidelines and my rules. If you don't know how to place your lines, I did a full 17-minute masterclass, and I even did a separate top-down analysis video. If you're interested in learning how to do that first, or this doesn't make sense to you yet, go watch that and then come back to this video. But if you've already done your top-down analysis, you know how to draw your trend lines, amazing. Let's pick it up where we left off. Bitcoin just gave us an indication that we are getting a possible trend reversal. the price of Bitcoin may no longer be trending up, this very short term up, and it may be moving along this newer downward trend line. You're presented with an entry. You're thinking short positions here. Maybe you even wait for the candle to close. Maybe you don't get in here. But if you do, let's go through as many different scenarios or as many different examples as we can so that this really hits home for you in case this is something that you are experiencing all the time. If this is the case, if you are getting into your position right here and you are placing your stop at a previous swing low, it could be here, it could be this swing low here. If you are placing your stop at a previous swing low, I want you guys to see why it does not work or why it does not complement a trendline trading strategy. So let's say you put your stop anywhere around this 69. And we've even got some previous touch points back here too. Like it's a valid key level, 69, 368. It's a valid key level here, but this does not complement a trendline trading strategy when we are anticipating price to ebb and flow, but to move along this new downward trend line. But let's say that you get into your short position here, you're putting your stop around this 69, 368. Let's see what happens. Now, let's say that you don't normally just get in right upon break. Let's say you wait for the candle to close. Okay, we've got another candle that's closed. Now let's say two examples here, two different types of traders. One's already in and they've got their stop set. The other one just now got in because they waited for the candle to close and now it's still on the other side of the trend line. So they're still anticipating this trend line break or this trend reversal. They placed their stop at a previous key level here, which acted as an area of support and very valid key level here, but just does not complement the strategy and very well could act as a area of resistance moving forward. But let's see what happens. Okay, moving sideways, but you're still up. Maybe break even. Oh, okay, we're close, and we're out. If this resonates with you, if this is something that you're finding yourself experiencing again and again and again, it is because utilizing the key levels or the support and resistance levels as a stop loss for the trendline strategy, it does not complement it or it doesn't suit it. We need to allow price to ebb and flow along this new downward trend line. This is what we're trying to get in on. So if you are placing your stops on previous swing lows or previous swing highs, when you're getting in on a trend line break or a possible reversal, even a trend line bounce, these do not complement the strategy. Now let's see an example of a trader who put their stop on the other side of the downward trend line. So not the key level, not the horizontal support and resistance, not the 69, 368, but put their stop loss on the other side of the downward trend line. Anywhere between this 70, 503 or this, anywhere between 70 and 71. Now this is also dependent on how much capital you have. As long as the position sizing is correct, you've got proper position sizing to allow the price to come back this far. If even one contract, one lot, one share, if you're trading the smallest position size that you possibly can and that still is too far away and it's over your 1 to 2% risk or your 1 to 2% of your capital, this is a setup you have to pass up on. Now this may not even be the instance for you and that may not be something that you're even worried about. But as long as you can trade a small enough position size to where you can allow the price to pull back and not only come close to or around this downward trend line, but in order for us to anticipate an actual loss or closing this trade or a proper stop loss, the price has to violate this downward trend line. Not come to it, not hang around it, not even touch it. It's got to clearly violate this downward trend line in order for a stop to get hit. So we're not utilizing previous swing lows that are within the new possible trend that we're anticipating it to respect. So we got in on this short position, anticipating a trend reversal, thinking the price of Bitcoin is going to follow along this new downward trend line. So utilizing this last random key level here is not allowing us to stay in for the entirety of the move or the entirety of the trend. So I think a big issue here is, one, a lot of traders may be trading too heavy in position size that they can't allow the stop to be around this 70-44 or on the other side of the downward trend line. They can't allow for that room, that wiggle room or that breathing room here, or the distance between where they enter the position and the opposing trend line. So that very well could be your first issue, is that your position sizing is too hefty, it's too high, and you're not trading small enough to allow price to kind of ebb and flow. or to allow it to not only come back to the trend line, but also violate it in order for us to know, okay, this is our loss, or this is our anticipated loss. This is our initial risk that we were willing to take in case the price immediately violated the trend line and did not respect it and did not continue down lower. Now let's see what happens for the trader who utilized the safety line. So they're placing their stop on the other side of the safety line. So if the price of Bitcoin comes up, violates the downward trend line, and hits this 75.18, then they are closing their trade. Then they're willing to take their loss and close that position. So now let's see what happens. Oh, and now we're at real-time price action. Oh, cool. Okay, so that trader that took that short position should still be in their position for Bitcoin. Now, the coolest part is as Bitcoin continues to move in your favor, this trader now gets to move their stop from 75.50 down to 70.23, down to 69.545, down to 69.820. So the trader that implements this dynamic risk, this dynamic stop loss that moves along the trend line, that allows price to ebb and flow, create pullbacks, create some higher highs and some lower highs, but as long as it is respecting this downward trend line or the new trend line that we're anticipating the price to respect, we're going to stay in this position. And the coolest part is as price progresses, you get to move that stop loss from the initial risk that you had, that initial loss, that initial 1 to 2%, then to break even. Then if the price of Bitcoin does continue lower and lower, that stop loss is now in profit. But this is so dynamic. So this is all dependent on what the price does. We have initial risk, and that's the one thing that we can control right off the bat, is if we get into our position and the price immediately goes against us and violates the trend line. That is our initial risk. And that still will happen. That's inevitable. There's going to be still many times that you'll get into a trade, you'll get into a position, and it will immediately violate your trend line. So there is the initial risk. There's always the possibility that this trade does not work out and the price will immediately violate your trend line. You'll take that loss. Now let's say that there's a scenario where the price does move in your favor. Now, worst case scenario is that you get to close this trade break even. And then as price continues to progress in your favor, now you're going to get a lot of break even trades too as well. So obviously we're working with probabilities here. We're just trying to set ourselves up for getting in on the new trend. Either getting in on a new possible trend reversal, so you're getting in on the start of a new trend, or you're getting in on a current trend and you're anticipating the price will continue, that you'll get that price continuation in on the trend that you've gotten in on. So you're either early to the party or you're just getting in on the current trend. But regardless, the coolest part is that this allows price to move with the trend lines, either react to them in any way, shape, or form, whether it's violating the trend line, whether it's respecting the trend line. Our stop is dynamic and it moves with price. So I think this is where a lot of traders get it wrong. I think this video is going to help a lot of traders out there that have been trying to piece together my strategy or a trendline trading strategy, and they are trying to implement other strategies for risk management that do not complement it. So as long as you can utilize the trend line for your stop losses and make sure that it is dynamic and it moves along with price, you're going to see a huge difference in your trading. And I think this is what a lot of traders are missing, is this safety line concept. Now what's super cool is I've seen a lot of traders and even educators in the space that have adapted or that have adopted this safety line idea or this safety line strategy. It allows them to hold their runners so much longer. It allows them to stay in for the entirety of a trend or the entirety of a trade. So the coolest part is this isn't like a new concept. It's just the way that I utilize it, and maybe the name that I've given it is a little intimidating to people, or maybe even a little comical to some people, depending on, if you're more advanced or more of a beginner. But this is truly dynamic risk. It allows the price to tell me when I'm getting out of my trade. It allows me to capitalize on the most amount of profits if the price of Bitcoin is going to continue down lower and lower and lower along this line. I don't have to guess how far down or how long the price of Bitcoin is going to trend along this downward trend line. As soon as it violates it, then I know the trade is over, my stop loss is hit. I have trailed my stop loss along this entire movement as it ebbed and flowed, as it continued to create these pullbacks and move along this line. As soon as the price violated the line, the safety line, I knew this was time to close my trade. Now, I do want to add a quick tip in here for those that are already utilizing the safety line. Maybe you're already utilizing dynamic risk, but you're still finding yourself getting stopped out of your trades too often. Or you're finding yourself having the right idea, taking the right entry, but you're still finding yourself getting stopped out. Make sure that you are trading small enough position size that you can allow price to actually hit the safety line. We actually anticipate that the price is going to hit the safety line. So if you are placing your stop losses on or at the safety line, that is your issue. We anticipate that the price is going to hit the line, and we even anticipate that the price is going to even ever so slightly poke through it. If this downward trend line was much more precise and implemented this high right here and then this next swing high at this 74.66, the price of Bitcoin would have violated right here. So I'm not naive to thinking that price is going to respect every single trend line to an absolute T or to the absolute tick. It's going to react to these lines in some way, shape, or form. Whether it's respecting it, whether it's violating it, whether it's hanging out around it, whether it's poking through it, creating a wick, I'm anticipating that. But as long as my position sizing is small enough, it can allow for price to poke through or to even touch the safety line. So it is making sure position sizing is small enough that you can allow wiggle room, price to hit the line, poke through the line, get a small wick here, before getting stopped out of your position, and then before seeing it continue in the favor or continue in the original idea that you anticipated. We don't want to get stopped out with every single wick or every single time the price hits the safety line. So just quick tip for those that are already utilizing the safety line, but they're still struggling, they're putting stop losses on or just right on the other side of it. They're not allowing for any wiggle room or any breathing room, any small wicks or price to get to the line. So what I just want to emphasize, the trend line is not your stop. It is your reference point. The stop loss should be on the other side of the trend line with breathing room, with wiggle room. So one small wick or as price gets to the line, you're not getting stopped out of your position. The price should be allowed to test the trend line. It should be allowed to slightly move through it or even spend some time around the trend line. At the trend line, touch the trend line, tickle the trend line, whatever you want. So on all, your stop should sit beyond where the trend line is. The goal is just alignment with how the market moves. We're just trying to get in on the trend. So instead of using the fixed static stop losses on these previous swing highs or previous swing lows, or maybe you're already implementing the safety line, but you're putting the stop right at the line and not allowing for price to react to these lines, I think this is gonna make a huge impact on your trading. Everyone preaches the 1% to 2% of risk, which I get it. That's like your standard basic operating procedure. All the beginners need to implement that 1% to 2%, and I agree. But at some point, you need to have room. And not only am I dynamic with my risk, but I'm also dynamic with my position sizing. Hopefully this was the missing piece that you guys needed in your risk management. Turn on the notification bell. I'm gonna be breaking this down in the next video, and I'll see you guys in the next video. Thanks for hanging.